saw a wild ride with interest rates this week. We saw oil go up. We saw interest rates go up. The 10-year treasury went up. The stock market dropped. We are seeing a little bit of a rebound this morning as everybody catches their breath to determine what's actually happening. In the meantime, there was an article that literally just came out, an interview that Axios had with the president talking about his evaluation of level of destruction. So I read that this morning, going exactly to what point can our economy continue to absorb? So that is still upcoming, and we are in Friday morning. So we're going to lead that story right into the weekend where it appears that most everything happens. So when we get in on Monday, we have these great little surprises of what happened to our market and our interest rates based on activity over the weekend. Now, there has been a pretty consistent acceleration of the aggravation of the current war situation every single day since the ceasefire broke down. That's put upward pressure on interest rates to the effect of, though, my having this conversation with you and my understanding it fully and being able to share this information is what helps us get buyers off the fence. I've met with several real estate groups this week that have been saying where the buyers, the listings aren't moving, this market has slowed down. I'm going to show you that we actually had a little pop-up business in the last week nationwide. I felt all of it. We had a massive uptick in buyers that were coming to us where I could have a very real, very logical conversation talking specifically about what was happening in Iran and with the oil situation. And I said, due to that, interest rates have peaked. And they're like, yeah, I know, I've been reading that. I'm like, good. Then I'm just going to take the rate conversation right off the table because buyers are getting used to higher interest rates, and they're very much in tune with what the current geopolitical status is doing to them. So if we hit it up front, it's not a surprise later on. Like, oh my gosh, my lender said 6.75. I'm going to go shop her. And then all of a sudden you realize, oh no, that is the market rate. So we need to be talking about what's happening in the economy up front so that we give them the full vantage view of what they're going to be receiving when it comes to the interest rate conversation. And even more importantly, the opportunities that they have in today's environment, especially in the Denver market, which is not the same as it is in every metro across the country. Right now, our benefit to the buyer. Now we can talk about days on market and months of inventory on detached versus attached. And Megan Aller and I just had the pleasure of speaking together last week. So if you missed it in person, which we had a ton of people there in person, which absolutely warms my heart. But if you missed it, we do it every 3 months. And she was specifically talking about the fact that the attached median sales price has regained everything that it's lost over the last 3 years. Now, the attached, you can't say the same thing for. But to understand the data as it pertains to the real estate market, and specifically the data as it relates to the headlines and the emotional state of your buyers and sellers, is what combined provides you the ability to be the most advantageous agent, partner, strategic partner, in fact, advocate for your client. And ultimately, that's all I want. That's all I want for you. So we're going to go ahead and share the slide deck. There's plenty to talk about. We're going to talk specifically about some lending opportunities that I'm providing my agents. We are staying very active right now with our listing agents. As you know, I am a lender. Lenders don't have anything to do with sellers. However, as you know, I also believe in giving more away than I receive. I want to make sure that we all rise together, that we are taking care of one another, because when we look to the right and to the left and we take care of those around us and we lift the positivity and the abundance mindset of this environment, then we all win. We all win because more buyers and sellers come to the reality of the environment and the situation, and they work together to present that, to sit at the closing table. That's what they do. They work together to sit at the closing table to give each other the next step in their real estate journey. Man, what we do is awesome. All right, let's get into it, because I've got more to talk about than I probably have time to talk about, because That's just how things go. That is just how things go. And I'm fine with it. I personally have no problem with running a couple minutes over. If you have to drop off, I do regret that. I will miss you. And remember to, we spend about 15 minutes, or I should say up to 15 minutes after the presentation. If you've got specific situations, buyer, seller scenarios, you want to ask specific questions, and if Peter doesn't address them during the presentation, we'll talk about them as a group. I want this to be a win for everyone that comes and joins me. This is not just me speaking at you. This is all of us lifting up this industry that we love so much for our buyers and sellers. All right. So I'm going to actually start with a quote from the dear Miss Megan Aller. It's her birthday today. If you have not wished her a happy birthday, and if you are social friends or real friends with Miss Megan, make sure to get that done. But you know the value that she also brings to this market. As I dive into the economy, she dives in and has all the data relative to real estate. But when we had our conversation last week, she brought up this statistic, which I thought was absolutely pertinent, that every real estate agent knows. And this is specific to her data set relative to the Denver Metro. So if you're outside of the Denver Metro, this is not a national statistic. This is a Denver Metro statistic specific to her data set versus DMAR's data set. 2/3 of all closings have a seller concession. 2/5 of all closings now have a price reduction. If you were with us last week, she had said 1/3. As she continues to watch the data, that is now inched up to 2/5 have a price reduction. And then 1/4 of all closings have both. We have to be communicating this with our sellers. This is a wake-up call for sellers today. They have to realize what they're needing to price at, how they're needing to stage, and prepare their home for the best opportunity to find that buyer. It also means that if you're a buyer's agent and I'm a buyer's lender, that we're looking for opportunities to ensure that our buyers have the most competitive advantage with lower bought down interest rates and or the combination of price reduction and interest rates. Now, I will say 100% of the time, it is more effective to take any seller concessions and use it towards a rate buy down. We need to be communicating that with our buyers versus a price reduction. But when they're getting both, or they have too much and we don't have enough costs and they want to do a combination of, it is absolutely a make sense scenario. Remember, this is limited to the interested party contribution limit. I'm having a lot of conversations around that as well. All right, let's get into a little bit about what specifically the Ruth team is doing for our sellers. A lot of you on this call have listings. If not, most of you on this call, yes, you might be working with buyers as well, but if you have listings, then you need to know that we have several tools specifically made for you. One of them is our appraisal. It's our desktop appraisal that we offer for our listings so that you can have that confidence when you're communicating with your sellers if you need to do a price reduction or what that should look like. If you need this, just call me. It's $250, which is nothing. And I'm even paying half of it with you because I want to earn your business on the buy side. So this is another way to have the tools available to you and to your sellers. With that also comes a flyer that we're putting together that will show exactly what the monthly payment difference is using a rate buy down versus a price drop. This is huge because it's saying from the seller, buyer, I am in this with you. I am coming to the table telling you up front that I'm going to give you 1, 2, 3, 4%. And my preferred lender is going to share in that and also match 1%. So if I'm coming in 1% and they're coming in 1, 2, or 3, we can drop that interest rate for the buyer by a full 1% rate. So it's significant. So we put together the flyer specifically based on your address, your purchase price, and the agreed upon seller concession. And then we show that to incoming buyers and also give you wording that you can put in the MLS. We also have temporary rate buy downs. I've done a few of those lately. I don't advocate for them, but they are an opportunity to have a really low entry rate for the right buyer. So if you need that, we still have the temporary rate buy down Excel spreadsheet that I can send to anybody who needs it, who hasn't gotten it already, because I know I've sent it out a ton. We also talked about this last week. With all the condo changes, we've been doing pre-listing condo approvals. We've been searching through the databases to see if it's already approved. We've been, with your help, working to getting the condo docs that we need to review to let you know if it's a problem or if it's clear to go. So we have amazing resources. We also love HOA Association. I do a lot of work with Jerry, so her and I partnered on a lot of things, but this is an opportunity to just give you the data to let you know what databases that condo project might be in. Because we all know the limited reviews are gone. They made up 40% of all the condo approvals. That's a very, very, very big deal. They made up 40% for a good reason, because that condo might not have passed a full appraisal, or full condo review. And now all condos starting August 3rd have to go through the full review. All right, let's talk about what's happening in the news, because there's plenty to talk about this week. We had an upsurge in disruption's the right word, in disruption in the oil supply. So we've been hyper focusing on the Strait of Hormuz, which is up here. Now the war has been taken to the Red Sea. This was also being used as an alternate source or waterway to get oil out of this region, and that has now been shut down. So now the Strait of Hormuz is shut down, and we're shutting down the Red Sea. That is going to impact, of course, oil supply, even though I've mentioned this on a couple of other presentations, that the United States makes enough oil for everything that we need, and in fact, we're the largest exporter of oil. It does not matter. It does not matter. Oil prices will continue to go up because of the global risk of supply and the global contraction of the supply against the demand that is going to make all the prices, including the United States, even though we have enough supply, higher, which is going to benefit oil companies in the United States more than anybody else, which is regretful. But anyway, all right, so oil jumped. So the ICE Brent Crude oil price jumped. It hit above 100. So we had seen that it had hit above 110 a couple times during the height of the Iran war. It had dropped off significantly, not quite to pre-war, but certainly close, when we all believed that we might see the end of this with the memorandum of understanding that was signed. Of course, I had made mention the first day it was signed that 60 days scared me. It was too long to give both sides time to lapse, which they did very quickly, actually. So we jumped up. Now we've pulled back just slightly from over 100 to 97. That was more of just because the speed by which it went up, it just had to relax a little. There's no good news that's making this come down. It's just sitting and waiting. And of course, a lot of this could be determined on what happens this weekend based on that interview with Axios that I brought up at the beginning of this, where the president did say that he is evaluating the massive amount of destruction that he wants to impart on Iran. So that was in the news this morning. So we're going to just have to continue to watch that, because it will impact oil prices and it will impact our 10-year treasury. So we immediately saw the odds of a Fed rate hike surge. As oil surged, that surged, which also caused, because at the same time we had, oh gosh, who was it? Google. I didn't put this in the presentation. I think it was Google that came out saying that they needed to raise a bunch more money for all of the things that they were doing with AI in the data centers. That spooked the stock market. So between the oil rising, with the Fed rate hike probability rising, and then the need for the AI funding, there's just a lot of spooking that was happening all this week at the same time. We also saw that the president, he put a sweeping when his tariffs were first determined to be unlawful, he set up this 10% on everything tariff. That is now expired. With that expiration, he's initiating another 10 to 12.5% tariff on 80 countries. That just happened this week as well. As we all know, this is an inflationary pressure. This will continue to work its way into the PPI, which is the wholesale inflation, the CPI, which is the consumer-based inflation, what I feel, and then the PCE, which is the Fed's preferred measure of inflation. We will continue to watch as conversations around this, around Iran, around the price of oil are all impacting inflation, all impacting the probability of a Fed hike, all impacting increased interest rates right now. So this is the story. So I'm talking to clients and I'm like, I don't know how it gets better from here. Not right now. Now, it doesn't go up forever. We have volatility in the market, especially without our forward guidance. We're going to have more volatility in the market going forward. Now, of course, we're going to hear from the Fed chair next Wednesday. I will absolutely be watching that and talking about it on next Friday's market moves. So we just got to stay abreast of what's happening so that we're aware, so that when it comes up from our buyers and sellers, we're not a deer in the headlights, that we are understanding, having conversation that hits that headline head on and allows them to understand how they fit inside that. Our industry right now takes a lot more listening than talking. It takes a lot more understanding with what's impacting their specific life. Because most times, 9.9 times out of 10, when I get on a phone with a buyer and I talk to all of our buyers, I am not asking them about a closing date or a purchase price. I'm asking them, what is the life that they're trying to create right now? How can I support that? And how can real estate be a piece of the puzzle that creates the life that gives them stability and safety and freedom? How do we come together and create simplicity where there's complexity, where there's an uncertainty and fear? And we all know that fear creates inaction. How do we come back to just being their advisor, to being their Sherpa, to listening, to helping them? All right. My gosh. So yields went up. It happened, right? So it broke through this level of resistance. So we saw yields jumped up past 4.7%, which hit over a resistance of 4.667. This morning, it came right back below that. It's just sitting there waiting to find out what is going to happen this weekend. But that resistance has been a pretty clear resistance. Right here, it stopped it. Here, it just almost touched it. Here, it went above it, but came right back down. It's the same thing here. It went above it, came right back down. This resistance is a pretty hard line, but once we break through it, it's possible that we could break through it for a while. But we did come right back down below it. That sent our interest rates higher. So we have a 6.85 right now. Of course, that'll back off slightly this morning. We are in this range. We broke out of our 6.6 range that we've been in through spring. However, if I look at a longer range for the last 3 to 4 years, we're actually sitting at the bottom end of that range because we've been in the 7 to 8 range for a number of times, and we've been sitting in the 6 to 7 range. And remember, 7% is the historical interest rate. I know it doesn't feel good with today's higher home prices, but this is actually kind of normal. And when I'm talking to people and they want to talk to me about ARMs, which are starting to get popular right now because the rates are so much better, if they're talking about ARMs or they're talking about temporary rate buydowns, I'm telling them that that might or might not be the answer, because I don't see interest rates really breaking below that 6.25 range for any reason that's on our short-term horizon. And even economists think for 5 to 10 years. But forget about the 5 to 10 year mark. Just think within 5 years. If that's not the case, then we have to make sure that the home price and the interest rate equals a budget that our buyers can feel good about, hit stability with, and then stay in. Getting out is the worst part of everything right now. So now we have this 81% probability of an interest rate hike at the September meeting, not the next week's meeting, although there could be a surprise rate hike. The European Union is talking about doing that. Not the surprise part, they wouldn't be talking about it, but they are talking about doing a rate hike sooner than later. So if we see that, more than likely we'll see it in September. I don't know. Could be this next Wednesday. And there's nothing that says that just because we see a rate hike, that means that we're going to see interest rates go up. Interest rates are being reflected by the same data that the Fed is raising or lowering the Fed hike. It's when they don't do what the market expects them to do that we actually see the interest rates get worse in one direction or another. So if they raise the rates, the Fed rate, it doesn't mean that our rates will go up, but it is the same threat, the same inflationary threat that's driving them to take action. So we'll continue to watch this. We'll continue to watch this without, much of a forward guidance. It's hard to see where that's going, but we'll continue to watch it. In other economic news, which there was not much of this week, very little economic news, a whole lot of geopolitical news. So there wasn't much economic news, but one of the things that did come out was the initial jobless claims. Look at that. There it is. I wanted to make sure that you saw it. It's so tiny. It's so tiny. So it dropped down to a low that we haven't seen since 1969. I can tell you exactly how many years that is. It's a lot. All right. So we haven't seen it since 1969. Initial jobless claims. Jobs for the moment are stable. And this job stability is what's keeping a floor under our demand right now. Doesn't feel like we have a hot housing demand, but this is what's holding the floor underneath it. If jobs disappear, we could have some sort of recession. Having said that, I've talked about this. So I do not cheer on a recession, but those who are in stable jobs will take advantage of lower interest rates should that happen. Mortgage purchase applications, interestingly enough, jumped up. Now, it is extremely important to clarify the data set. So this is a data set that came out on Thursday, and it showed it was through Tuesday or Wednesday when really the height of the soaring of the interest rates and the oil prices happened on Wednesday and Thursday. So this is not going to collect that. We were seeing more of a stability of the interest rates. Yes, still on the higher side of the last 3 months. But not the spike that we just saw at the end of this week. So I imagine that will come back down next week when we get the updated report. But for right now, I certainly felt all of this and more. We saw a massive uptick because I've been talking about this. Buyers are getting used to interest rates at 6.5. They're not liking 6.8. I can tell you that right now. But they're very much getting used. And remember, the 6.8 specifically is 25% down with a primo buyer. You have buyers right now that are getting quoted 7 and 7.25, even 7.5. That is what it is. If they have a low credit score or a risky profile, that is not far off from the truth. These rates are the best buyer rates. Best buyer rates. Mortgage purchase applications are flat year over year. We've kind of circled back to where we were last year. We're continuing to see a little bit of an inch of growth, not a whole lot of growth over last year, but it's still a strong year. Last year was a good year for our side, just being creative, strategic, and meeting clients where they were. So next week, we've got some big news. We've got the Fed interest rate decision happening. We've got PCE, which is the Fed's preferred measure of inflation. And then we have consumer sentiment all coming out next week. We'll be talking about that on next week's market moves. All right, I'm going to talk for the last 7 minutes a little bit about housing. So Daryl Fairweather came out, Redfin's chief economist, saying that most of the country is still in a buyer's market. There are absolutely seller's market, Illinois seller's market, Connecticut seller's market, the Northeast. So, but we are in a buyer's market squarely, and a lot of the country is sitting in some variation of that. But they are saying that plenty of home buyers are tired of waiting on the sidelines and they're entering the market anyway, i.e. they're getting used to higher interest rates. They're getting an understanding where they've weathered the storm long enough that they've now determined what is my stability inside this uncertainty bubble. Because there's a lot of this uncertainty bubble that I can't control. So I can either sit here and continue to wait on my future success, or I can choose to take action, move forward, take a step in a direction that moves me towards wealth, stability, security, multi-generational legacy, whatever that goal set for them is, that vision for them, despite the uncertainty. That is our job. The uncertainty will still exist. In fact, I believe it's our new normal. So the sooner we get used to it, the sooner we can help our clients get used to it. We saw the report come out from NAR talking about the generational home buyers. I want to double click on this because a couple of reports have been coming out specifically about the amount of wealth that is sitting in the baby boomers bucket and how that wealth is going to transfer. And I just want to talk about it because I don't think it's going to mean much, but it does mean opportunity, and it's an opportunity within that generation. So here goes. So we saw that baby boomers continue to remain the largest buyer pool. The largest buyer pool, right? They hold 42% of residential real estate right now. And they're 42%, sorry, not holding 42%. They are 42% of the buyers. I titled that wrong. I apologize. So they are 42% of the buyers, which is the largest. Considering Gen X is 25 and millennials are 26, it's quite a bit higher. They also own a large percentage of the real estate, which equates to 14.92% or 14.92 trillion in equity. That is a lot. We used to use a number that was 11 trillion. It has jumped up because we've seen home prices continue to increase. Yes, specific metros have not seen all of that, but they have been holding those homes for a long period of time, right? Because of that, now they control roughly 50% of the household wealth. which goes beyond just home ownership, right? This is investments. This is home ownership. They own 50% of the wealth and they represent 20% of the population. Who are your buyers right now? Who are you talking to? Are you avoiding the baby boomers? Do you not know how to have conversation with the baby boomers? I've got some real estate agents who are absolutely crushing it in the space, who have made websites specifically for the baby boomers looking for more appropriate lifestyle housing. Right? If they're looking for the lifestyle housing, do you present the solutions for that? This is a major subsection of both our buyers, our home owners, and our generational wealth holders. Massive subsection. Now, this transfer of wealth, though, they've started to delineate who is holding the wealth, and it is the top 10%, with the top 1% gaining the most from the wealth transfer. So the wealthy are becoming wealthier. It's not rippling down. It's not rippling down, which is why this conversation is so critical, so important right now. So it's going to be transferred. Now, we still have, interestingly enough, I want to show you this, Millennials and Gen X's still for their age are wealthier than the baby boomers were at that time. The baby boomers have experienced some incredible, especially with the pandemic, some incredible wealth gains through their real estate. I mean, we see this big bump right here, although we've given some of it back. Major bump in equities, major bump in real estate. Yet, at that age, millennials and Gen X's are doing pretty well for themselves. We've got to tap into the conversations. I was just reading another article talking about the fact that although we've been seeing this slow appreciation nationwide, it is abnormally skewed towards the luxury market. Those who have are spending. Those who have are spending. We talked about this last week. The M2 money supply hit another record high, which is the liquidity in the market. We talked about how many new millionaires were made. This money is making money. There are a lot of buyers out there, cash buyers, luxury buyers, and there are people who are dying to get in, which is why it's so critical that we understand the data so that we can have the conversation. Because I am seeing a lot of TikTok videos. I hate TikTok. We're seeing a lot of YouTube videos talking about the fact that I sold all my real estate. I'm getting out of real estate. Don't own real estate. And I want to tell you that yes, while the equity market is now the number one wealth builder, not real estate, it is amassed to the top 20%. They are the ones that are making money on money. It is the middle America that so needs real estate because it is the very small step that takes them to a position of stability. They don't have the kind of money to put into the equities market to see the kind of growth that's going to multiply to the numbers that we're representing here. So understanding the numbers and then being able to explain how those headlines, yes, are true. And I can have a both and environment. Yes, the equities market is the biggest wealth gainer right now, not real estate. Yet, for middle America, real estate is the only way that they can raise their level of living slowly through monthly principal and interest payments, through small appreciation, through the ability to rent out rooms or the home or ADUs. It gives them access to options. They don't have enough money to put it in the equities market to have the kind of gain to meet the kind of retirements that it takes to live right now. So we have to find the solutions. Right now, for a lot of our either buy before you sell, generational, those baby boomers, they're sitting on an equity. They bought a home for $150,000 and it's now worth $950,000. They're trying to figure out what to do next when that is the majority of their wealth. How do we get them out of that home and into the next one? My team has never done as many bridge loans as we're doing right now. Bridge loans to access the equity in that home, then a guaranteed backup offer to remove that home from their debt to income ratio, and then a non-contingent offer, or a cross-collateralization product that we have that allows a buyer to purchase a new home with a reverse mortgage. We are making options. We are making strategic solutions. We are creating legacies, and we're taking all this data, all this wealth, and we're putting it into action and creating solutions for our buyers, which is exactly why I think next month's, yes, I had to think if it was this month or next month, August August Agent Ignite is so critical because we're going to be talking, it's a 2-hour CE talking about reverse mortgages. Here's what I want to leave us on. Not only are we supporting that wealth generational transfer, we're supporting the meeting the baby boomers where they're at. We're supporting middle America where real estate will continue to hold their greatest amount of wealth. Right? I've shown that chart before and I'll pull it out again. When you talk about between the different levels of net worth, where do they hold their assets? And in the middle, it is real estate. It is real estate because you're seeing all these headlines that say get away from real estate, yet it's still the solution. So we just rolled out a 0 down. So if somebody's in a position, there's no income limit on this. We simply put a second behind it for 3 to 5% so that they can do it. There are payments on that second. I don't want you to misunderstand this. It is not a grant. It is a loan. There are payments on it, yet it gets somebody in when they know they have the ability to. I don't want to stretch somebody beyond their ability, but if they have the ability, but they just don't have the money, or they want to keep their money for reserves, which I love, we have the ability to do a first and second to 100%. It is game changing. It is game changing. So much of what we do is understanding what's happening, the data for the real estate market, the data for the geopolitical and economic market, and how those two intersect to create either a knowledge base and understanding or an inconsistency, uncertainty, and fear. And that's where buyers are at. And that's what we want to protect. There's always a lot. There's always a lot to talk about. I want to leave you with this. What we do is critical to the continued wealth in America. We are supporting the middle. We are serving the luxury buyers. I love serving the luxury buyers. And yet we are also serving the down payment assistance buyer who needs that help, who's putting together the 80 or the 97, 3% 2 loans to 100% situation. We are helping everyone get access to this train on the wealth journey. So much to cover. Please let me know. Peter, was there any comments that you did not already cover?
No, I crushed them all.
You crushed them all. Does anybody have anything that they want to talk about? We've got time. I've set time aside for you. Either I did a really good job or I confused the shit out of you. I don't know which. I'll take either. Guys, I just want to thank you so much for spending this time with me because yes, please. Oh, all right. With that, I am going to say goodbye. I'm going to say have a happy Friday. I'm going to let you guys know that because you're working, we're working. Kara Nelson is on call this weekend. We want to support you, your clients, get into the home that meets their budget, meets their dreams, and drives them towards a vision that only we can help them create. Give me a call. If there's anything that I can do to support you, I'm all in. I'll talk to you guys very soon.